Puggy, am I audible?
Yes, Mr. Mahir, you are audible. Thank you very much for joining.
Pleasure.
Let's begin. Good afternoon, everyone. My name is Deepak Mukhi, and I'm the director of FICCI Maharashtra. I'm sorry, actually, there was something technical, in this. So, am I audible?
Yes.
Yeah. Okay. Thank you very much for joining the day fourth, which is the last day of MSME week. We had a very exciting 3 days session before Eid holiday, and it covered in short the policy, the incentive regime for MSMEs, along with how access to finance, is important, and how people can access that, various tools, various initiatives, and digitalization as the core theme for last 3 days. The last day of fourth day or last session of this MSME week is going to focus on global MSMEs, ways to strengthen the participation of MSMEs in global value chains. And as we all know that exports are key driver of economic growth and job creations, and so does MSMEs. And with recent changes taking place across globe, the economic situations due to geopolitical reason, and government of India's focus on promoting exports and having a set target to achieve certain numbers is being pushed hard, and a lot of policies are being unveiled to support that. It is in form of FTA, it is in form of foreign trade policy and related areas. So some of these things we thought could be brought to fore if some of the MSMEs are not still aware about them, and hence this session. Today we will be covering four prominent area. One would be we'll cover, as you all know, that India, UAE, SEPA, and Australia ECTA has recently in past year come into force, and we'll be discussing today the India UAE SEPA basically, and what is the benefit in it for MSMEs. Along with that, we will also have a presentation on what is the new foreign trade policy have for MSMEs. Along with that, we will also have presentations on what Maharashtra government is doing for facilitating sports from the state, which will happen towards the end when DC joins us. And Mr. Sau from ECGC would be talking about the insurance part as well during this session. Without further delay, let me first invite Mr. Samir Navani, who's the head of India office of Dubai Chamber of Commerce. He's been working with Dubai Chamber for last 5 years and has overall 14 years of experience in corporate and Chamber of Commerce both. And I would invite him to give his presentation on what is there in India UAE SIPA for MSMEs, and in general how it is panning out after a year of completion. So Samir, over to you.
Thanks, Deepak. Thank you very much. Allow me to share my screen and
while you are sharing your screen, just for everyone's information, this program is being currently web streamed on FICCI Byte platform primarily. There are some people who are joining us on Zoom as well as on YouTube, and on FICCI Byte there's a facility to ask questions. The Q&A button is given on the right bottom side of your screen, so please feel free to ask those questions. Yes, please, Samir, over to you.
Well, thanks, Deepak, and good afternoon, everyone. Firstly, it's a great initiative by Fiki, so congratulations on running the MSME week and covering the entire depth of topics that you all are covering during the week. So I know it's the last session for the week, but it's an important one as well, given the India-UAE relationships and the CEPA being signed. There is very visible excitement that we are seeing amongst the businesses to explore potential business opportunities on either sides. So I'll dive straight into the presentation, and in the next 10 to 15 minutes, what I'll largely be doing is I'll be touching upon three main topics. One is sharing a little bit about the UAE and India, and touching upon the India-UAE relationship so far, and then moving on to the recent changes that are happening and the CEPA agreement that has been signed between India and UAE. What we'll be doing on the CEPA agreement largely is it's a very exhaustive document. So we'll be touching upon the key aspects for the businesses, for MSMEs that would be relevant for businesses. And then I'll run you through the way in which you could look at CEPA from a perspective of doing business in UAE as well. And then I'll touch upon a little bit about the Dubai chambers and what we do here in India as well. So India and UAE have a long and strong lasting relationship, be it economically, be it physical proximity to each other, or be it the people-to-people relationship that we share between India and UAE has been extremely, extremely strong. And if you look at UAE in the region, it is the leading country in the region, if you are speaking about it from a competitiveness perspective, to being one of the modern countries in the world, or being amongst one of the most innovative and the safest countries in the world. It's amongst the leading destinations in the region, as well as in the top 10 or 15 countries globally as well. Similarly, if you look at Dubai in the region, Dubai is amongst the leading destinations or leading cities in the region when it comes to being the best city for expatriates, for people to live, luxury residential markets, innovation, trade, travel, tourism. Dubai is amongst the leading destinations in the region. When we look at CEPA and the recent changes that have happened, the India-UAE CEPA made a lot of sense from multiple reasons, and there were multiple reasons why that made sense. One is because India accounted for about 14% of UAE's non-oil exports in 2021. That was right before CEPA was signed. And UAE is the third largest destination for Indians to export their goods. And UAE accounts for about 40% of the India's total trade in the Arab world. And then we have the FDI from UAE, which touched $12 billion in 2021, making India the 9th largest recipient of FDI from UAE. Now, that speaks about the depth of the relationship India and UAE share. And that is where CEPA was signed, to further strengthen the relationship, because the potential is way beyond what we are seeing here. Now, what CEPA covers, CEPA is a very, very extensive document with a purpose of defining the benefits that businesses can have between India and UAE after the signing of CEPA. It also defines the criteria and the compliances that businesses would need to do in terms of availing these benefits. And it also speaks about how these compliances are going to be evaluated. And it also speaks about the G2G collaboration and how can India and UAE further strengthen this G2G collaboration between themselves. And it also speaks about ongoing review and dispute resolution mechanisms that will be applied. Now, that is very, very extensive and very exhaustive. So what we're doing in the interest for the businesses, we'll be covering three main topics from the CEPA that were signed. The CEPA has about 18 chapters and 11 annexures that are there as a part of the entire agreement. But for today, we'll just be focusing on three main aspects of CEPA. One is the trade in goods, the other is trade in services, and the third is the government procurement that has been defined in the agreement. Now, when we speak of trade in goods, one of the things that has happened in the trade in goods is a lot of the custom duties have been revised. Now, there are links that I've added to the presentation right now, but I believe I'm only sharing my current screen. So when I click on the links, it won't be visible. But at the end of the presentation, I have a QR code in case anyone wants to visit these links. You can just scan the QR code, share your contact details with me, and I'll be ensuring that you receive the links over email, which are the key links for you to understand SEPA as an agreement. So in trade and goods, the custom duties have been revised, and there have been largely 4 categories in which the revisions have happened. One is for the entire HS code spectrum, one part of it has an immediate tariff elimination. Then there is a second part of it which has seen staggered tariff elimination over a period of 5 years. And then there are some HS codes where there is a tariff elimination over 7 to 10 years. And then there are tariff reductions for some of the products and HS codes by about 50%. So these are the 4 segments in which the custom duty reductions have been classified. And these are accessible on a UAE government portal as well. And that's the link that I have hyperlinked over here, where you could just key in your HS code and see what's been the tariff reduction or custom duty revision for your particular codes, for your particular products. And then there are rules of origin that apply when the revised custom duties are being applied, because the countries want to ensure that the goods that are coming in either from India or from UAE are actually from India or are actually from UAE. And how do we classify the rules of origin? That is where there are certain products where there is a requirement that the products need to be wholly obtained or wholly produced in that particular country. So for example, if we speak of fresh fruits and vegetables, if we speak of live animals, if we speak of products like these, those are the ones that are coming into the segment where the requirement is that these products should be wholly obtained or produced in a particular country. And then there are certain segments of products where there is a requirement that they should be undergoing significant in-country value addition before being exported, for those products to be considered as produced either in India or in UAE. And a lot of these, the information about each HS code chapter is available on the product specific rules link that is there on the presentation as well. But broadly, they are bucketed into 2 or 3 segments that, as you'll see. One is that says that there has to be a value addition of 35% on the ex-works price or 40% on the FOB price for the products that are being exported. Then there is another segment where the raw materials itself are very expensive, like precious metals, semi-precious stones, so on and so forth, where there are different rules of value addition that are being added, which is in the range of 3.5 to 7%. And then textile is another exception where there are different product specific rules where the requirement is that the non-origin raw material that's being used in the textile has to be 7 to 10% of the weight of the entire export that's happening, so on and so forth. So these are the rules that are defined in the product specific rules that is available. And then when we are speaking of SEPA and exports under SEPA, there is a specific certificate of origin format that has been designed, which covers a lot of these aspects in terms of understanding the rules of origin and understanding the product specific rules being met, so on and so forth. And that is where there are specific agencies who are issuing these certificate of origins if we need to leverage SEPA, and that list of agencies is also available on the hyperlink over here that's shared. Another sector which has been very unique is the pharma sector, where there are technical barriers to trade, but then pharma sector has also seen a separate chapter or a separate section in the SEPA, wherein the governments have agreed that if the pharma facilities have products that are already being sold in one of the 6 countries, which is Australia, Japan, Europe, US, UK, and one more country that I'm missing, but if it's already registered in one of these 6 countries, then there is a fast track process for registration of your pharma products in either of the countries, which is between 60 to 90 days. So those are the kind of regulations that are easing the pharma product registration process as well, and on both the sides. when we speak of trade and services, the trade and services covers about 11 sectors and 100 subsectors. And it speaks about a couple of specific things when it comes to services. One is an access to market. And what SEPA says is that be it India or UAE, they will be being open to giving an access to market to the services companies from either sides, and they will be given a favorable treatment in terms of being considered as local businesses when it comes to trade and services or services companies trying to do business on either sides. Telecommunication is another segment which has seen a separate segment in SEPA for itself, wherein the governments have agreed that they will be supporting services businesses in the telecommunication sectors as well. And by providing support, what they mean is that they will have no restrictions in terms of access to network and systems that is required on the telecommunication systems for providing their services. Full technical support will be provided to provide those services for the services businesses to be able to comply with their deliverables. And there are certain segments where there are sensitivities and securities involved, is where the governments have agreed that there will be some level of protection that will be incorporated in the telecommunication sector. Besides that, it's fairly open for the trade and services businesses to enter either of the markets. The next important thing when it comes to services is the movement of people moving from one country to the other for providing those services. And the governments have agreed to streamline the process of application for people to move from one geography to the other, and ensure that there is information that's readily available for them to understand what is the process that needs to be followed, and to ensure that the application process is fulfilled in a reasonable amount of time. So that's something that's being done on the trade and services side under the SEPA agreement. The last part that we'll be focusing on when it comes to SEPA is the government procurement, which is again a very big part. And that is where the India as well as UAE have identified agencies, government agencies for which the government procurement will be open for businesses on either sides. And that list is again available on the hyperlink. Just to reiterate, the hyperlinks that are there on the presentation are available on the QR code that I have at the end of the presentation. You can always fill in your details, and I'll ensure that you receive the links that I'm mentioning during the presentation. Now, when it comes to government procurement, there are a few key things that have been agreed upon between the governments. Is that for large part of the government procurement, an Indian entity will be considered or given a national treatment when they are applying for government tenders in UAE and vice versa. And there wouldn't be any discrimination between Indian or UAE businesses when they're applying for government procurement on either sides. Now, there is a caveat where the MSMEs are protected, and the governments have agreed that wherever it's in the interest of their MSMEs to be involved, those regulations on the government procurement or on the procurement mandates would be detailed, saying that this is where the MSMEs of our own national countries would be applying for these government tenders, and those details would be available on the tender document where MSMEs can be protected. And then there is wherever there is a registration system that's in place, and there is a requirement for an entity to be pre-registered as on the vendor list of a particular for a particular government project, those requirements would remain, but the governments will be ensuring that those processes are streamlined and there are no unnecessary technical bottlenecks or other things that would be blocking businesses from India or from UAE to be on the vendor registration list on either side. The other things that are happening on the UAE side is there has been a strong push on the manufacturing side as well, where the government has come up with an initiative called Make It in the Emirates. And under this initiative, the government is planning to increase the industrial value add from 138 billion dirhams, which was in 2018, to 300 billion dirhams in 2031. And for that, what the government of UAE is doing is it's onboarding businesses locally to have offtake agreements for about 300 different products. And there are already quite a few businesses that have been onboarded, like ADNOC, TAQA, EGA, so on and so forth. And there have been offtake opportunities for different sectors that have been identified worth 110 billion dirhams, which will be executed between now and 2031. And these are some of the sectors where offtake opportunities have been identified, and the value of the offtake opportunities that have been identified. It largely covers industrial segments like drilling equipments, pharma, defense, technology, heavy industries, chemicals, medical consumables, so on and so forth. Next, recently, Dubai also introduced Dubai 2033 plan, which is called as the D33 plan, under which the Dubai government has highlighted the roadmap that it plans to achieve, or the key pointers that it plans to achieve over the next 10 years. And these are largely bucketed into three segments. We'll see some of the projects that have been highlighted, or the key projects highlighted, are bucketed into three different segments. One is developing trade and business, wherein Dubai intends to double the size of its foreign trade by adding about 400 more cities to its foreign trade map. The next initiative that is there on the trade front is where Dubai is launching the Future Economic Corridors 2033 and opening up economic corridors in developing world in Africa, Latin America, and Southeast Asia. And there is another initiative that is proposed, which is for developing SMEs and helping them scale up, and where they intend to identify 400 high potential companies and help them and support them to build their capacity and grow globally. The next initiative on the trading side is also launching Dubai Traders Project to empower new generation of traders in key sectors. Another initiative that's being focused on is on the education and the job market side, where Dubai intends to attract global best universities and invite them to Dubai to make Dubai home and provide higher education and make Dubai a global destination for higher education. And it also plans to integrate about 65,000 young Emiratis into the job market. The third segment of this plan focuses on tech, wherein Dubai plans to launch the Sandbox Dubai initiative, which will allow testing and commercialization of new technologies in Dubai and will enable Dubai to be a major innovation hub. The next thing that's happening is they want to focus on, or Dubai wants to focus on, having 30 companies, identify 30 companies that can be scaled up to be global unicorns in the new economic sector, which is the new age technology sector coming out of Dubai. And the last segment where the plan focuses on is again manufacturing and industrial products, where the focus is on green and sustainable manufacturing sectors and segments that can be attracted to Dubai. Now, when it comes to the Dubai Chamber of Commerce is the apex entity in Dubai. And the Dubai Chamber of Commerce in 2021 went through a large restructuring, where the chamber has been split into three large business units. One is the Dubai Chamber of Commerce, which is called the Dubai Chamber of Commerce, where the role of the Dubai Chamber of Commerce is to promote business advocacy. Then there is the Dubai International Chamber, where the chamber plans to open 50 offices globally between now and between 2021 and 2024. And the objective of setting up this international offices is to build a network of international offices that any business that's coming into Dubai can leverage. So, for example, if you're speaking about Indian businesses coming into Dubai, the offices would be responsible for bringing in these global businesses to Dubai, and then from Dubai, helping them scale and grow their operations globally. So that's the objective of the Dubai International Chamber. And then we have the Dubai Chamber for Digital Economy, which focuses on the entire digital ecosystem in Dubai and building and attracting new age global businesses to Dubai. Specifically to Dubai international offices, until end of last year, we were at 15 offices. We added 4 offices in 2022, and now there has been an exponential and massive expansion that has happened this year. As we speak, we have already added about 8 offices in Southeast Asia, Europe, and Africa. And we intend to close at about 30 offices by the end of this year and 50 offices by the end of next year to build that entire network of offices for businesses that have a presence in Dubai. And that is it from my side. In case there is anything you need to know, I would urge you to scan the QR code, share your details with me, and I'll share the links that were shared on the presentation today related to SEPA, and you'll have my email ID as well to reach out to me in case you plan to explore Dubai as a market for your next expansion. Thank you.
Thank you very much, Sameer. This is a very good presentation, crisp, and gives a lot of flavor of what is going on under India UAE SEPA, sorry. But I just want first, will this QR code also be giving details of that D33 plan in case if someone wants to get more information? You talked about sustainability and related areas. So how those details someone can find out?
Sure. So Deepak, anyone who's scanning the QR code will be receiving an email from my side. So they'll have my email ID and they can always reach out to me for anything specific that they need about Dubai, be it information about D33 or understanding specifics about their sector related to SEPA or not related to SEPA, even for exports. More than happy to support them.
Okay, great. I just wanted to ask you one question on related to SEPA, because we were discussing with some people, and then they said that there's no mechanism for dispute settlement in it. Is it true? And if yes, I mean, don't you think that for MSMEs it becomes very difficult considering the cost and other thing in terms of any kind of resolution? So even larger companies may face problem, but still they have wherewithal to do that. But for smaller companies, since we are talking about MSMEs today, do you think that dispute settlement part can be addressed? Any info on that?
So Deepak, there is a separate chapter on dispute resolution under SEPA, which details in terms of how the dispute resolution will happen in case there is one that arises. And there could be 2 different segments of dispute that could come in. One is from an individual trading perspective, and that is where I believe the authorities or the agencies that have been appointed for issuing the certificate of origin under the SEPA agreement would be the ones who would be best able to guide in terms of the compliances that are required for SEPA. But besides that as well, when it comes to safeguarding the economies as well from a perspective of anti-dumping, or from a perspective of any particular sector being hampered and it needs to be revisited, those kind of clauses are also there in the entire SEPA agreement to ensure that no sector is being affected, and if there is something that's happening, it is open for discussion as well. So there is a detailed plan on that.
Okay, great. And how has Dubai Chamber you see over last, I think it's now for almost 14 months now that it got implemented. So how do you see uptake on it? We do hear additional trade happening, non-oil trade happening and increasing. But how do you see within this whole trade MSMEs actually contributing? You have any kind of ideas or numbers or ballpark figure that how it is being panning out in last 14 months, and what do you expect to see in coming years?
So Deepak, the trade numbers, overall trade numbers have certainly seen an uptick. And I believe it was at about $88 billion last year, the last numbers that I remember, which has been up from about $60 billion. So there has been a huge uptick that we have seen overall in the trade. And a part of it is, of course, the SEPA agreement. From a Dubai Chamber India office perspective, we have seen a huge uptick in terms of the number of Indian businesses that have started approaching us. And at forums like these, whenever we are speaking or engaging with businesses at different forums, we are seeing the amount of interest that we are seeing from businesses has drastically increased. The good thing about India, Dubai, and India, UAE specifically is that the proximity and the diaspora connect is so strong that we are seeing businesses taking the next flight to Dubai and going and exploring opportunities. We are seeing people from Dubai and UAE as well exploring investment opportunities in India. We are seeing businesses from Dubai exploring trade opportunities largely and trying to identify specific segments in India where trading is of high interest for them. So that's something that we have certainly seen an uptick as the number of queries have gone up.
Okay, okay, that's a good news. So we would like to see, further strengthening of our bilateral trade, especially in on-oil. That will help a lot of companies from both the sides. So I think, Samir, this was a very great presentation, and thank you very much. I hope many people would have, taken the QR code. Plus, this will be available on the FICCI YouTube channel as well. So I'm sure people will refer to your, slides later on as well. But thank you from FICCI side for joining us today and sharing your views on the India UAE SIPA.
Thank you, Deepak. Thank you, everyone. Take care.
Thank you. Now we will move on to our second presentation, and I would like to invite Mr. Arun Sahu, who is the Assistant General Manager from the Export Credit Guarantee Corporation of India, to give his presentation. Mr. Sahu, you're on mute.
Good afternoon, sir, and good afternoon to the participants. I'll be briefing you about the ECGC role in the export scenarios which our country is doing. Just a moment.
So you are again gone on mute actually. Your presentation is visible, but you are on mute.
Okay.
Yeah.
Am I audible now?
Yeah, now you are audible as well as your presentation is visible.
Okay, I'll be briefing the participants about the role played by ECGC in all these years and how ECGC can be useful in covering their payment risk. So ECGC is basically a credit insurance organization set up under the Ministry of Commerce, working under CLICHES, and it is way back in 1956. So we are having the experience of around 65 years, and it is 100% owned by Government of India. And basically we are coming under the administrative control of Ministry of Commerce. We are governed by the board of directors, and board of directors basically are from the various fields as well as from the government also. And being as an insurance organization, we are also regulated by the IRDA. And recently, for the second time, we have got the General Bajaj Uchit Vyapar Award also in 2018 as well as 2022 also last year. And we have got the IAAA rating, ICRA rating for the highest claim paying ability which we have. And Department of Public Enterprise has also awarded us for the procurement from the MSMEs. This was the Now coming to ECGC basically have two verticals of business. One is for the exporters we are covering, and another is for the bankers, which we cover. For exporters, we are covering their short-term exports, medium and long-term export, as well as their overseas risk. In short-term exports, we are covering the exports. Short-term exports are those defined where the terms of payment are less than 180 days and payments are coming in a year. That is known as the short-term exports. And medium and long-term exports where the payment is coming after 1 year, or project export basically, which we say that the medium and long-term exports that we cover it. Under the banks portion, we are covering the short-term, the credit finance which are given by the banks, packing credit and post shipment. And in the medium and long-term export, project finance which is given by the bank, that also we are covering. Here, basically, ECGC is covering two types of risk. One is the political risk, another is the commercial risk, which we are covering. Under political risk, coming first to the political risk, we are covering the contract cancellation. Suppose goods have been exported and in the meantime, the buyer of the foreign country cancels the goods, then that risk stands covered by ECGC, because once the goods is sent and bill of lading has been issued, and definitely it will be a loss situation to the exporter. So to cover this loss, we are covering that contract cancellation. Transfer delays. Transfer delays means where the many of the countries which now they are facing the payment crisis, where the buyer has made the payment to their central bank in the local currency, but due to the foreign exchange problem, the money is not coming in our country. That type of risk we are covering under the political risk, and it is known as the exchange restriction or inconvertibility problem, which we are covering by transfer risk delay. War risk we are also covering due to any, suppose the goods where they are exported and any war starts between the two countries, then that risk covered with ECGC. Another risk which is covering under the political risk cover is the import restriction cover, like the goods have been shipped from India, and in the meantime that country comes up with a regulation to not to provide the entry in of the goods to their country. That is known as the import restriction risk. So that risk also ECGC covers. And another risk is that a diversion of voyage. Like suppose recently, few years back, Suez Canal problem occurred. So some voyage has to be diverted. So in that case, the general insurance companies or the shipping companies charges the extra amount, premium from the exporters. So that extra payment can be reimbursed from the ECGC, which comes under the clause of what, diversion of voyage, because it is all of the sudden actually. It is not pre-decided that this, generally the path is pre-decided. But if due to some any unforeseen circumstances, the path has to be changed, then obviously the shipping companies are charging the extra amount. So that is beared by ECGC. If ECGC, it is covered by us. This was a few about the political risk. Another set of risk which ECGC covering is the commercial risk. In commercial risk, basically we are covering the protected defaults, insolvency, repudiation, default by the LC opening bank, or insolvency of the LC opening bank. Now, default by LC opening bank, like in US also, some of the bank has become insolvent. So that type of risk, if the transaction is, we all feel that LC is the safest terms of payment. But in LC also sometimes the non-payment occurs. So that risk is covered by ECGC. If the LC opening bank denies to make the payment, or if the LC opening bank becomes insolvent all of a sudden, because inside story of the bank we don't know. So that risk stands covered with ECGC. In commercial terms, we are covering the insolvency of the buyers also. Like in India, now we have introduced the bankruptcy code, but this bankruptcy is in practice in the other countries. Like our major export destination is USA, and in USA the insolvency rules are also very relaxed actually. So you never knows when tomorrow some buyer will become the insolvent overnight. So because we are, as an exporter, we are seeing it from the outer side only. but inside financial story, we don't know what is going on inside. So as these countries guideline laws also supports the insolvency, or they do not pressure, to that risk is nowadays much. So we are covering that insolvency risk. Any payment which is due to the exporter on the buyer who become insolvent, then claim can be easily lodged with ECGC, and their loss can be recompensated by ECGC to the exporters. Now, protected default comes generally in the terms of payment, when the terms of payment is DA, where the document against acceptance. For the participants' point of view, I am telling that for their knowledge, that under the DA terms of payment, here buyer is not making any payment. First of all, he will accept the goods. Now, suppose he accepts the good at 90 days, 60 days, 180 days, 120 days. So he will make the payment after those terms of payment, after those days only. Now, suppose he has accepted and he will sign the bill of exchange. He has signed the bill of exchange, he has taken the goods, but after 180 days or 120 days or 90 days, he is not picking up your phone or not ready to make the payment or making excuses. So that type of risk stands covered by ECGC under the clause protected default. Another thing which also we are saying as nowadays is that, and recently in the value chain cycle, that now buyers are exporting not for the direct consumption of their own. They are also supplying it, the goods which they are procuring from us, they are supplying to someone else. And once the payment comes from them, they are after cutting their commission, they are transferring the payment to us. If suppose their ultimate buyer happens something, so that payment cycle can be cut. So that type of risk can be covered under the protected default. Another risk which we are covering is the repudiation risk. Repudiation risk means this risk occurs when the terms of payment is cash against document, CAD, where the goods have been shipped. But here people say that we all feel that the risk is not involved under the cash against document, because document will buyer will make the payment as when he takes the delivery of the goods. But here the situation arises that suppose you have dispatched the goods have reached the foreign port, but there the buyer didn't comes up to make to accept the goods or to make the payment of the good. Then exporter will suffer a loss, because in port after 7 days you have to clear the port, or the damage charges will start occurring. So to avoid this type of situation, ECC is covering the damage loss also. If suppose there we gives you the option to go for the alternate buyer. Now, in case of the alternate buyer, whenever like a car we are purchasing from the showroom, we are paying, and anyone is paying what the company MRP is. But once the car is out of the garage, company showroom, one cannot expect to get the same price which he has paid to the company. Actually, everyone will try to take the situation, and he has to give some discount on the MRP or the invoice value. So same is with the export transaction also. Once your goods reaches the foreign port, and if your original buyer is not taking the delivery of the goods, or he doesn't comes up to make the payment of those goods, then we gives you the option to go for the alternate buyer. Now, if the exporter is successful in finding the alternate buyer, then he will also try to take advantage of the situation. He will also ask for some discount. And so in that scenario, ECGC is covering that loss actually. So whatever discount, but you have to take the approval from the ECGC, and we are covering that loss. Suppose in worst cases, if the exporter is not able to find the alternate buyer also in those scenarios, then in those situations, we are giving the permission to re-import the goods back to India, and total warehouse to warehouse expenses we are paying in, and that loss is covered by ECGC. That's why we say it is a repudiation risk. So these are few of the commercial risks which we are covering under the export transaction. Now, some risk which we don't cover, like commercial disputes, we don't cover between the buyer and the exporter. Suppose he says that the quality is not up to the mark, but that issue has to be resolved. Then exchange fluctuation risk we don't cover. Exchange fluctuation, agency failure, sometimes that buyer has made the payment to the foreign bank, but the Indian bank have not received the money, or they have transferred, foreign bank has transferred to some other account. that risk is of the agency failure, which we don't cover. Any loss or damage which is covered by the general insurance, we don't cover. And the cyber crimes, we don't cover actually. Now here we have major policies. Earlier we were having only few policies. Now according to the circumstances, according to the changing needs of the exporter, we have also changed the many of our policies. Like shipment comprehensive risk policy is a very old policy of organization where the exporter can cover his entire turnover. Here the benefit in that in this policy to the exporter is that as he is covering up with the entire exports, so the percentage of cover is also on the very higher side. And every year, if no claim, premium rate is also very less. Every year, if no claim is coming, so discount is also being given to the exporters. Another policy, we have the small exporters policy. This is given to the exporters whose turnover is less than 5 crore. Here, good thing has happened in this policy recently to support the MSMEs of ours. The ministry has agreed that they will reimburse the premium of 5,000 rupees of the exporter for the first year. So whatever premium he is paying for first year, he will get back that amount from the government of India. Another policy we have here the exporter can cover the single export also. Suppose he don't want to cover up the entire exports. He only feels the risk in covering the single exports. To that single buyer policies he can also come. We also have the exposure policies where suppose outstanding at any point of time is 20 lakh or 1 crore or 5 crore from the buyer. So that amount he can cover, which we say it as a single buyer exposure policy. And the duration of that policy will be 1 year. So that entire exposure will be covered for 1 year actually. And the policy is designed in such a way. So those exporters who don't want to cover their entire kitty with us or entire export, they can go for the single exposure policies. Another policies which we have, there's a multi-buyer exposure policy. This is a very golden policy of the organization. This is shipment comprehensive risk, and difference between shipment comprehensive risk and multi-buyer exposure policies that in shipment comprehensive risk, one has to submit the monthly declaration basis, whatever export it is taking place. So it is observed that it becomes very cumbersome to few of the exporters, those who are exporting in the big quantities, that every month to prepare the shipment declaration and submit it. And in the suppose any of the shipment skips, and if that payment is specific, if specifically the payment of that shipment doesn't come, so it becomes the loss to the exporter. To avoid all this and make it a user friendly, we have come up with a multi-buyer exposure policy where one amount is fixed, which is known as the aggregate loss limit. Suppose exporter is having the turnover of 100 crore. So 10% of that export turnover 100 crore, he can take the 10 crore as the aggregate loss limit. Now 10 crore, whatever aggregate loss limit he has taken, so 10% of the aggregate loss limit means 1 crore per buyer will stand covered. Here, the advantage is that he don't has to take the credit limits on the buyers specifically. Only check here is that we will provide the user ID and password to the exporters, and he has to check that buyers should not be in our B-cell list. B-cell list means actually to those buyers where ECGC has paid the claim or some non-payment has occurred of any of the exporter. We have put those buyers under our buyer specific approval list. Adverse experience list we have put it to that those buyers don't stand covered. So only otherwise in multiple this MBP policy, exporter don't have to submit any declarations. Only quarter, and the payment option, premium payment is also quarterly payment he can go for the payment of the premium. If he goes for the yearly payment of the premium in a one installment, then additional discounts are there which he can take. Another policy we have is the export turnover policy. In export turnover policy, but this policy is for those exporters who are having the huge, big exports, and they here the commitment should be there from the export that ECGC will get the premium of 10 lakhs. In this policy, we are giving the upfront discount of 20% that way. Another policy, but it is similar to the shipment comprehensive risk policy. Another IT-enabled services to cover the IT exports. We have issued these policies. During the time of the claim processing, after if the export is covered, the claim procedures are also being simplified by ECGC year by year, day by day. We are covering, we are simplifying our claim procedures. And see, these are the basic documents which are required for the claim processing, like contract and order copies, invoice, bill of lading, or yearly bill, as the mode of export is there. Non-payment advice is required. Original unpaid accepted or bill of exchange, it is required only in case of the DA transactions. Correspondence with the original buyer, what follow-up he has done from the buyer for recovery of his dues, and correspondence for recovery actions. See, in all these documents, no such document is there which exporter has to prepare at his own to get for the lodgement of the claim. These all documents automatically will be there if the non-payment is there or if the export is there. So only these basic documents are required for our claim processing. Thank you. If any specific queries are there of the participants.
Thank you, Mr. Sahu, for taking us through various, policy of ECGCs and how one can claim that, and also what benefits it entitles to the exporters. If anyone has any question, please feel free to ask. I have put a request on YouTube and Bike and here as well. So if you have any question, please suggest. Or we can even take question later on also. Mr. Sahu is here in case someone wants to think about the questions.
Thank you, sir. Thank you very much.
Okay, so I think at this moment I don't see any question. But if we have any question, Mr. Sahu is with us, so we'll come back to you, Mr. Sahu. Thank you very much again for your presentation, and also to ECGC for partnering us with MSME Week. Let me now move on to our next speaker, Mr. Mihir Ajit Shah, who is the partner of Universal Connections. He's a certified trainer in the field of international business, including trade agreements, policy incentive, etc., and also provide consulting and advisory services in relation to foreign trade policy and subjects related to EXIM business. So we thought that since foreign trade policy was renewed this year, we thought that we will have a bit of information session on foreign trade policy as well, that what kind of benefit it provides in general and especially to MSMEs. And hence we requested Mr. Shah to give us a presentation on the subject, as he's been kind of doing these presentation quite frequently. So Mr. Mihir, over to you, and we look forward to hearing your views on what foreign trade policy is all about. May I request Mr. Arun Sahu to kindly close his presentation? Thank you, sir. Thank you. Over to you.
Yes, very good afternoon. Thank you, Mr. Deepak Mukhi and Team FICCI. I hope I'm audible. Perfect. So very good afternoon, everyone, and thank you for joining on this fourth day of the week-long MSME week celebrated by FICCI. It is very, very easy for a third batsman to come when two stalwarts have really played well in this afternoon. You just have to chip in few more runs to score a big number. So that's my role today, and I'm very happy that both Mr. Samir Navani and Mr. Arun Sahu did a fantastic opening batting before this session of mine. The task given to me is to explain you about the foreign trade policy 2023, which I think if you are an exporter would agree was a sight to look at on 31st of March. because whether we like it or not, the previous policy, which was 1520, was to be, announced or what to be closed on 31st of March 2020, and a new policy should have started. But then COVID happened, and then we got extension and extension and extension multiple times. So just that requirement that, okay, we should have a new foreign trade policy, that desperateness was already there amongst the exporters. And finally, on 31st of March, we got the new foreign trade policy, which effectively starts from this financial year. Very interesting part to note in this policy at the beginning of the upfront is that this is the first time that you will hear a policy with only 1 year in the description, that is Foreign Trade Policy 2023. You go back in history and you will find n number of policies, but there will always be a policy which would have a starting year and an ending year. So it is the FTP of 1520, 914, maybe 49, n number of old period, even 1995, 96 onwards, you will see there was a start date and an end date. But the interesting and a very unique thing which was there, or which has been part of this policy and which was clarified by the department when they announced this policy, is those are different times. This is different time. And in 2023, we want it to be more robust, but at the same time, we want it more fragile to adapt changes. We want to make it open enough so that at any given point of time, there requires an amendment, change, correction, based on industry inputs, based on circumstances. We don't have to wait for a year or 2 years or 5 years. We have an open foreign trade policy, which can be done and amended any point of time. And things which are consistent, which are good, which remains as it is, they continue to happen. It doesn't require an amendment. So why do have an end date? Effectively, we have a FTP of 2023, which has technically no end date. It is open for all amendment changes at any given point of time. Structurally, we used to have about 9 chapters. We have changed few chapters, added few more. So we now have about 11 chapters under the policy. Not going into the very technical or theoretical aspect of it, but we have had 2 very specific topics. One, which talks about the developing district as export hubs, which was already discussed separately, which is now incorporated in the FTP. We're talking about e-commerce and digital trade. This is also become part of FTP now under Chapter 9, and certain specific commodities which are covered under SCOMET is also come into part of Chapter 10. Obviously, the usual schemes of advanced authorizations and EPCGs and EOUs and deemed export continue in the relevant chapters, and we still have those going strong. But there are really good changes which, as an MSME, as an exporter, and as an overall structural reform, as you may call it, as needs to be understood from a contextual understanding, so that an exporter understands that what are we thinking and what is the nuances of the foreign trade policy. To begin with, we are going to be part of the World Trade Organization Trade Facilitation Agreement. So there is going to be a National Committee on Trade Facilitation. Now, this is very important because the committee focuses on 4 key pillars. Transparency, which comes with making ease of doing business, which comes with the second pillar, which is technology, which is also going to be driving our ease of doing business. Simplification, which is obviously the end result of technology and transparency, where procedures of documentation, paperwork, doing the same thing again and again would be avoided. Risk-based analysis, rather than taking everyone with a doubt, self-certifications will be the part of it. And that's how it is being done, where obviously the technology is going to play a key role, where artificial intelligence and algorithms and AI will play a very, very key supporting role. And last but not least, where the state governments, the local administrations will come into picture, is the infrastructural facilities. So all of these has to be taken into a holistic manner, and that's exactly what the foreign trade policy looks into or wants into. So the idea to mention here is that we understand, the policy does understand that it is not just some benefits here and there. It's not just procedure. It's not just, roads and things. It is complete. It's the entire ecosystem which is to be strengthened. And that's where the National Committee on Trade Facilitation is going to be looked into. In fact, they are going to also enhance the existing Niryat Bandhu. It is one of the very interesting scheme by the department, which is through the DGFT, where hand-holding of exporters to grow their businesses happen. The Niryat Bandhu schemes will enhance more information, more counseling, more training, more outreach program, specifically directed to the district as export hubs. They will also build in people like FICCI and others who are industry partners, knowledge partners. And the key idea under Niryat Bandhu now is going to be that how can at district level we can have a product and a market going for the international business. Just to highlight few facts in terms of how are we looking at this from a technology perspective, then well, we have an entire dedicated online platform which is robust enough now for last about 3-4 years. It is perfectly doing well. Most of the services related to foreign trade, whether it is the licensing, whether it is as simple as an IEC code, to as complex as special licenses or import permissions, all of them today are online on a single platform. Agencies which ensure you RCMC or council membership are also online on the same platform. We have the certificate of origin. Samir did mention, Mr. Navani mentioned about the FTA, and this requires you to issue a specific certificate of origin, which is a preferential COO. We've gone ahead, the department has gone ahead to make not only the preferential, but all certificate of origin digital, e-based on a single platform, so that it's easier for the exporters to operate at a click of a button. We have a 24/7 help desk facility, and we have made the systems so robust that it is easier than ever before. Simple e-governance process where the basic details of exporters are already captured. They are linked now with income tax, registrar of companies, Ministry of Corporate Affairs, GST, Udyam, that is Ministry of MSME, banks. All of this exchange of data is already there. They will soon be onboarding the chartered accountants, the company secretaries, and the chartered engineers, so that all these data can be automatically synced and always available to you in an automated process. So they will not necessarily require somebody to approve it. It is a system which will decide and approve many of information. Just to add on to all of these, it's not just only web-based. We also have the mobile applications available for both Android and iPhone to help you on that understanding. So that gives you the idea and the flavor of what digital and technology area of foreign trade we are looking at, and support we are trying to, or the policy is trying to build in. But obviously, for a newcomer or an exporter who is existing but wanting to grow his market, would want to look at some numbers, some data, some information, so that he can plan, strategize, do some number crunching in terms of where the market is, what it is, and how it is. Obviously, in many of the cases, especially in MSMEs, you are not the first runner. You are not the first one. Now, in that scenarios, obviously you depend on some external agencies, but those agencies are A, not sure of authenticity of the data, and B, unnecessary, has a lot of charges and things like that. Well, government has Trade and Statistic Division, and it provides you data for merchandise exports, which are on a macro number based, giving you enough information to do your research, to formulate your trade strategy. So whether it is the Commerce Ministry's portal on commerce.gov.in, or whether it is the Directorate of Trade Statistics and Intelligence at Kolkata, which provide you information. In fact, a free dashboard called Niryat is available to all the exporters. The dashboard is a fantastic tool in a very visually clear manner. where you can look at the period, the time, the product, and so many number of details are available, whether it is in form of which export port is used for your export product. So you could filter it, or you could select a product from a specific port, or you could specify it. Let's say when I was listening to Mr. Samir, he's talking about UAE, I could probably filter it to a product that says, okay, is the product going to Jubilee more or to Sharjah Airport, Sharjah Seaport more, or to any other of the similar lines of ports. So these could be the informations which are available at a click of a button. They are not any cost. It's a completely government authenticated data. So you will have to understand that that can help you in a better manner to plan your activities. To talk about that we want to develop cities and towns and districts is one aspect, but to actually do it and support it, the Ministry of Commerce under the foreign trade policy for years have been running a scheme called Towns of Export Excellence. A requirement of a specific export threshold limit. If that town is able to capably do it, then they get certain incentives in form of MEI schemes where common facilities and common projects can be supported, and the government would be part of it and support it financially and procedurally. 4 new towns of excellence have been identified and added to the existing list, making it totally of 43 towns. Faridabad for apparel, Muradabad for handicrafts, Mirzapur for handmade carpets and dari, and Varanasi for handloom and handicrafts. So these are the towns of export excellence. The idea, if an exporter today can carry with him, is if you are from a town which has already been identified, you could be part of that group where common facilities can be shared. But if you are not, but if you are willing to invest time and effort and bring that export growth in your town, maybe your town could be the next town of export excellence. Since the change of chapters have happened and things have moved a little bit from the schemes, a very interesting certification and a recognition which was given to exporters who do on a regular basis and a good export turnover is a scheme called Status Holder Certificate. So Government of India would recognize exporters who do regularly a good amount of exports, and there's a threshold limit for it. There are 2 conditions to be understood. Number 1, you have to do a certain amount of exports and you have to do it consistently. The consistency is being measured by you making performance in current plus previous 3 years. And mind you, there has to be export performance in previous 3 years, all of the 3 years. So just doing an export in 1 year and then not doing it in previous 2 years will not have you get the necessary certification. So it's a consistency plus obviously contribution. Now, how much is the contribution? There was a limit and there was a detail. We have now reduced that so that more and more people can, or more and more exporters, including MSMEs, can get better recognition. So the total export required for the current plus previous 3 years for a 1-star is $3 million. For 2-star certification, which was earlier 25, reduced to 15, 100 reduced to 50 for 3-star, 4-star 200, and 5-star $800 million worth of export you need to do. Let me re-clarify for all the audience very categorically. It is not an annual requirement. It is the total exports for current plus previous 3 years total together. Now, since we are on an MSME Week platform, it is obviously better to give some additional advantages to MSME, and MSME has always been the focus, not only for various departments of the government, including the Ministry of Commerce, for exports also. So when Ministry of Commerce strategizes for export strategies, MSME also focuses, and which gives you a double weightage as an MSME, as an ISO or a BIS certificate company, units in a specific northeastern states of Sikkim, Union Territories of Jammu and Kashmir and Ladakh, or exporters of vegetables under Chapter 7 and 8. If this is what your area is, then for the 1-star export house, which is the first one, where the requirement is originally $3 million, your exports will be counted as double, which means if you are doing an export and your total export is roughly around $1.5 million, because it becomes double, you automatically get qualified for the 1-star. So if I'm an MSME certified by the MSME under the Udyam registration now, then roughly doing an exports of INR around 12 to 13 crores total, which is around $1.5 million, would make me eligible to certify as 1-star export house. Now, apart from giving you credentials, obviously the policy also talks about, and if you remember back a couple of slides, I mentioned that the government or the DGFT or the foreign trade policy, the Ministry of Commerce is thinking on enhancing the Niryat Bandhu scheme by taking the support of institutions and also for support of knowledge people. And that is also going to come from the status holders. The status holders are obviously the ones who have done exports for a while. They understand this is international business. So now, not only by giving you accreditation and certificate, they also expect you to help in growing by making you partners as a mentor and help train people under international business. So some compliance form of for 2, 3, 4, and 5-star requires you to train 5, 10, 20, 50 people for that year. Finally, the validity of the certificate is for 5 years. So the moment you register, you are assured that for 5 years that certificate is valid, which can help you market yourself as 1-star, 2-star, 3-star, 4-star, or 5-star exporter from the country. My note to the current exporters, if you're already a status holder, and if you have this certificate issued in the previous policy, please note that this would expire by 30th of September. As on date, the notification of the handbook process says that the old certificates, which are issued under the 1520 policy, the previous policy, will expire by 30th of September. So though the certificate says your expiry is December of 24, technically now it will only expire in September and you'll have to apply fresh. So have a note on that for your reference. Now, when we're talking about export, there are some basic requirements which also need to be understood, and the foreign trade policy has been a very mix this year in a very good manner to say what is there existingly, but also mixed and updated the various nuances which have happened in the past couple of years and to update it with the real current policies and provisions, including whatever clarifications required. So obviously we know that IEC, an importer-exporter code, is required for anybody to start export or import in the business. But there was always a confusion for a service category of exporters, whether we should have an IEC or not. It has now been very clearly clarified that you require, if you want benefit, and please understand, if a service exporter wants benefit under the FTP, then it is not that subsequently you can have it, because the IEC should be valid on the date of rendering the service. So I, as an advisor, I as a trainer, if I'm thinking of doing an export of service, and if I want to take benefit under foreign trade policy, it is not subsequently that I can take. I should have had the IC the day I offer the service. And that's the clarification which helps people to make less mistakes. For all those who already have an ICR in exports, friends, please note you are required to update your IC every year in the month of April to June electronically. And when I say April to June, Mr. Mukhi has selected this last week of June precisely for that, to remind all of you that today is 30th of June. In case if you have not updated, hold on for this session, and after the session, please go back and update it, because today happens to be the last date. It's a complete online process. It hardly would take you not more than 5 minutes to update it, but it is essential to update it. Otherwise, the chances are it could get deactivated from tomorrow. We now move to a point which was been discussed and talked about in all press media. I'm sure every one of you as an exporter have received WhatsApp saying we have started getting, or we can get export remittances in INR and payments in INR. Well, friends, please understand the FTP. Yes, there is a process, but please be very clear. FTP is very categorically clear that number one, if you export goods out of India, you need to get realization, that is, we call the export proceeds, in free convertible currency. There is a July 22 circular by the RBI which allows a process through which the foreign banks can pay you in INR or accept INR against your imports, but that is only and only strictly via that special account which is called as the Special Rupee Vostro Account, SRVA. So just merely that somebody or your buyer says, I will pay you in INR, don't jump the gun, don't run around. Understand that if the payment can come only and only in rupee through the Special Rupee Vostro account, only then it will make sense for you, because your incentives, your benefits, your processes will get closed only strictly when it is coming through the Special Rupee Vostro account. If it comes from any other method, it will not be agreeable. We have done this not on this open forum like Special Rupee Vostro account, but in the past with Iran as a country where mechanisms were set to, even today, you can get money in INR. So similarly, this is open for any country anywhere in the world who wants to start and give payment in INR, but provided a bank from that country opens an account through an Indian bank, having a Special Rupee Vostro account, making a request to the RBI, and once that is set up, payments to you as an exporter gets routed through that Special Rupee Vostro account. Only then it is eligible. Many of us in current time and mainly in the COVID period have had chances that buyers wanted products, but you couldn't export from India. So, but there were scenarios where you could buy from some other country and export it, popularly called as third country transactions or foreign transactions or drop shipments. The technical word is merchanting trade, where you buy from a country and you sell to another country without goods touching Indian ports. They do not enter India physically at all, but of course you make some margin money. A clarification has been added into foreign trade policy that it is allowed, and this has been accepted because there were some RBI guidelines which said merchanting trade should be as per foreign trade policy, and there was some mismatch whereby FTP did not define it. So now FTP clarifies this very, very clearly. I did mention about chapter 3 where we were talking about developing as districts as export hub. This initiative has been started long ago. In fact, the idea to bring one product from one district and bring it at a center stage globally was originally, if you remember, from the speech of the Prime Minister on the 15th of August of 2019. And it's not that we've just had a speech and everybody is forgotten. In fact, a dedicated platform called exporthubs.gov.in has been created. In fact, each state has identified districts, each districts have identified products, and a lot of work has been already happened to promote exports from district level. If you look at Maharashtra, we already have divided so many of the districts, and in specifically from where I come from in Mumbai, we have various products including gem and jewelry and services sector which has been identified. The beautiful part of districts as export hub is it not just works with central government. In fact, the state government has a very active role in it. There is the DGFT, the agencies, the ECGC, FICCIs, and the associations or local bodies take. So the idea is very simple. Instead of doing it top down or central to district, it is district to the world. And that's been done on a global level across the India spectrum. And now it has been part of the foreign trade policy. We will in near future look forward for various specific provisions coming for district as export hub. So as once this products and the ideas roll out from the districts, you will see much advanced stages of development in terms of schemes and policies under the district as export hubs. The old schemes, the very strong, resilient schemes, which has stood the test of all times, which as an exporter is a requirement, because you have to be duty neutral, you have to be cost effective. So either you exempt the import duties on raw materials or you refund it. We have that in various forms of advance authorization, DFIA, duty drawback. The new schemes like ROTTEP and ROSTEL, they all continue under the foreign trade policy. So whether it is advance authorization where you are eligible for duty-free raw material, which is incorporated in the domestic product. So you import raw material, manufacture the finished goods and export. All duties, whether it is customs duty, additional customs duty, anti-dumping, countervailing, safeguard, or GST, all of them are exempted, provided there are conditions to be followed. You complete the manufacturing with a value addition, meaning you bring in more money. At least 15% value addition is compulsory. Or there are certain specific products like tea and gems and jewelry, where tea we want 50%, gems and jewelry, of course, we don't want 15%, we want about 3%. Then there are certain quantity restrictions. So this is the scheme which is already there. There is no change. I'm just repeating for the understanding purpose to come to a context why I'm saying so. So as a part of the scheme, there is an import and export. You import raw material, you manufacture and export the finished goods. So to import raw material, you had a time period of 12 months, and then you had to do extension twice. Again, the whole concept, Deepakji, that we are talking about is bringing its simplicity, system driven. When I want into the policy an extension available to you 6 months and 6 months twice, which means at the background, I'm very clear as the policymaker has 12 months, why not give them upfront? Nobody wants to delay the benefit, right? So why would somebody? So the straight process is you have an original license of 12 months. You want to revalidate it, take 12 months straight away. No questions. One single application, matter over. Obviously, you have import raw material, you have to export the finished goods. And then there is a time limit of 18 months to export. But at times there could be a situation where you are unable to fulfill your exports for certain challenges. Again, there was this hurdle of calculation, of calculating that whether how much you have exported, if you want extension, based on that percentage, then how much you have completed, we would give you an extension with some fee. So there was an element of calculation and delay. What has now happened is they have done away with all that. They said, okay, you want the extension. The first extension, which comes for 6 months of period after you have not completed the 18 months of exports, you have not finished it. You want another 6 months. There is a block of 6 months which you can get. Whatever is your license value, the import value, we give you a fixed fee. So 2 crore rupees is your value, you pay 5,000. If it is 10 crores is your value, you pay 15,000. So from 2 crores up to 2 crores, 5,000, 2 to 10, 10,000 and above 10, 15,000. There's a fixed fee. I don't need to check how much export you have completed. This means the entire process of export obligation extension can be automated. Nobody needs to verify because the system is already know the facts and figures. You come to the system, you say, I have a license more than 2 crores. You want an extension of 6 months. The system will tell you to pay 10,000. You pay 10,000, 6 months extension instantly given to you. You go for the second extension. You're still not able to do it. Pay another 10,000 or 20,000 depending upon the value, you get it. So the idea is we have done away with the whole process of calculation and made it more and more system driven, which is the whole purpose which we started with. Now, obviously these are penalties or these are some late fees because you're not able to export. But when you start application, there are certain government fees. And talking about the government fees, again, here we are looking at MSMEs. And I was looking at this yesterday for some different purpose. And you'll be surprised to know this. First of all, let me tell you what is the benefit. The benefit is that the licensing fee under these various schemes of advance authorization and EPCG, which originally used to be 1 rupee per 1,000, with a cap of maximum of 1 lakh rupees. For an MSME, if your value of license is up to 1 crore, you pay only rupees 100. For 1 crore, you pay only rupees 100. And if it is beyond 1 crore, you pay only rupees 5,000. And I can tell you very categorically, because I had done this working yesterday only itself for somebody that who has a regularly import and a regular licensing, where he used to pay 1 lakh rupees on a scenario, and maybe was doing about 4 or 5 licenses a year, which means he would have ended paying up about 5 to 6 lakh rupees as government fees. Now being an MSME, his maximum fee is 5,000 rupees. Multiplied with 10 licenses, he would have paid only 50,000 rupees. If you do the maths, 1 lakh rupees worth is equal to 20 authorizations. I think in last 2 years or last 3 years, he's not done that, which means the amount of fees which he was paying for only one license is now going to take care of probably multiple of years. That is the amount of burden which has been reduced to MSME in terms of even processing fees. Merely 100 rupees and 5,000 rupees. Look at the IEC fees, 500 rupees. You do modification, 200 rupees. So these are the kind of scenarios which you will have and which you will see in terms of an advantage which is available. The schemes like DFIA, the scheme like Rostel, ROTTEP, they are all continued the same. There is no change in the foreign trade policy. Just to give you an overview of ROTTEP scheme, it is a duty remission where you get a refund of duties and taxes which are not refunded in any other manner. It is in form of a script, though it is a foreign trade policy scheme, but it has been monitored by the revenue department, that is the customs. The scripts are now valid for 2 years. You can pay the basic customs duty out of it. And currently, though it is 10,481 as I mentioned, but I think the actual figure goes now beyond 10,500 plus HSN codes which are covered. Obviously, there are some which are not covered, but still most of the schemes, most of the products are covered under the ROTTEP scheme. The focus of the government has always been to be a production-based country, and more manufacture happens into the country, for which if you require a high quality, a better machinery or capital goods, EPCG scheme has always come into the forefront. The scheme is to allow you to bring in capital goods duty-free. Lot of questions and queries come up because it's a long-term scheme, because you require to don't pay duty, but you have to export 6 times of the duty saved in a period of 6 years. So it's a long-term scheme, and a lot of clarification or issues come up, but those have been taken care and they've been clarified. Scenarios where you could import now in 24 months. So now an exporter who probably wants to buy about 3, 4, 5 units of the same machine to set up an entire plant, and if he is getting machines in a deferred delivery, getting every machine after 6 months, he did not worry, because one authorization is good enough, because he has 24 months to import. Certain clarifications which were required have been added into the policy, where average export obligation, it can be completed or should be completed only in the financial year till the export is completed, and so on and so forth, has been taken care of. People are confused for that rupee payment. We have already clarified that it is only and only the special rupee goes to account. The exactly same has been reiterated in these scenarios. Annual reporting of your EPCG is a compliance which is required. That is also been clarified in this new policy. Not only clarified, but an online platform or online process is also available. Again, friends, unfortunately, the last date is today, 30th of June. Practically what I've seen is department is liberal enough to allow you to submit, or maybe even submit later on. But please note, as per policy, if you do not submit by 30th of June, 5,000 rupees per year is the late fee or a penalty which applies to you, and you might have to be paying that when you go for a closure. So some procedural advantages or changes have happened, which you need to understand, that earlier they were not available. You could just read in the book that it is online, but there was no process. Now, obviously, you have a process in place. Chapter 6, 7 talk about deemed exports, EOU. They are all continued as it is, which is why I prefer that it is not a very lucid thing to, repeat the whole entire story again for you. But chapter 8, which is an interesting chapter, which was, introduced first time in the previous policy, which talks about quality dispute and complaints and trade disputes. In fact, when Mr. Nawani was speaking, Deepak, you did mention about what happens for the disputes and trade, issues. So, well, we have under the DGFT, under the foreign trade policy, an entire chapter dedicated to issues related to quality complaints and trade disputes. Exporters, importers can take help of this benefit of these quasi-judicial kind of a mechanism where complaints related to foreign buyers for quality can be created. Foreign buyers can raise a complaint against Indian suppliers. Indian exporters can raise complaints related to foreign buyers non-payment. Buyers can also complain related to short supply, partial delivery, non-payment, and all of it. So the entire mechanism is to try and address issues of business, and the government takes it very seriously. In fact, government takes assistance of the Indian missions abroad to take these cases further. Obviously, everybody has to fight their own battle, but this is in support which can help you. The advantage or the advent of this new foreign trade policy is that we now going to have a dedicated case officer for a timely dispute of this matter. So every dispute which you record online will have a case officer assigned at the DGFT level who will take care of it. There is no person today and no business who can say today that we can survive without an electronic or e-commerce or a digital economy or a digital business. We are more connected than ever before globally. I'm sure today, if you spend an entire day, at least half of a dozen times you have spoken to somewhere in the world through some digital medium. You don't think about where you want to buy from. If you want to buy, you can buy things or goods from anywhere in the world. So online e-commerce business is going to be the next booming part of it. Foreign trade policy understands that. Identifying and talking about it is the bigger challenge. We have started it by chapter 9, where we have identified that it is an objective for the government, or objective for the ministry, objective for the authorities to boost the e-commerce business. The challenges are many. Some of them have been started to be addressed, like very basic, to define what do you mean by e-commerce exports? What do you mean by e-commerce services? What is an e-commerce platform? Who is an e-commerce logistic provider? So the very basics have been clarified. Yes, it is still at a nascent stage, but it will be where we've started a couple of steps. One of that interesting step is to increase the value limit to rupees 10 lakhs per consignment. So today, if an exporter of small articles doing courier or postal shipment can export goods worth 10 lakh rupees in one consignment. Mind you, friends, it is per consignment, not in a year, not in a month. So I could send a goods worth 10 lakhs today, tomorrow, every day of the month, or maybe even 4 shipments in a day. As long as it is per consignment, 10 lakhs, there's no problem. So my gems and jewelry businesses, my handicraft businesses, which are of higher value, have no challenges. Finally, there is another segment which requires a special care and special mention, are the products which have a special chemicals, organisms and materials, technologies and equipment. This is abbreviatedly called as COMET. The idea or the context is very simple. A same product has a dual use. One, what is called as a commercial or a normal use or a civilian use, and another which is used, could be used for weapons, destruction, or some other prohibited activities. So these are classified as COMET items. A specific list of these is available, and those require certain controls and measures, is what our new chapter 10 defines and talks about. Lastly, the chapter 11, which happens to be the pushback of chapter 9, where definitions and general miscellaneous items work. Now, let me end by giving you the exact 360-degree that we said that we want technology and ease of doing business. And I talked about digital and we said reducing payment. But does it really change on the ground? Then, well, look at this scenario where we have this entire timeline of how the applications have to be closed. See the change that an application which would normally take 3 days for an advance authorization through an automatic route. Why an automatic route? Because we have now got everything digital, will take only 1 day. It is printed, it is recorded, it is a person, somebody is answerable if it doesn't happen in 1 day. And it's not in one place, every place. We talk about EPCG, we talk about advance authorization. Normal EPCG would take 3 days. But if it's under automatic route, it is under a system driven, it happens in 1 day. And that's exactly what we are saying. It's not just talk, but it is also an action which is available. Friends, before I leave you back and get back to Deepakji again, just a mention that there was an amnesty, or there is an amnesty scheme for certain compliance procedures which are there, though not directly part of the foreign trade policy, but comes along with the policy with an intention that if you have some old pending matters which are where you have not been able to export and you want to close off the liabilities, you could go it with a reduction of interest payment and all of it. The only challenge again is, friends, this scheme came up on 1st of April with a time limit that you had to decide to participate in the scheme if you're eligible by 30th of June, today being the last date. So as of date, as before I came online, I don't think so there's an extension given. So I'm assuming this is the last date. So just to mention on that is something which is there. So with that, let me thank each one of you. My many thanks to FICCI and team, Mr. Deepak Mukti in specific. Friends who would wish to have a copy of this presentation, there's a link available with a code which is nothing but today's date. You can log on to speakersco.it and download the presentation. Thank you so much.
Thank you, Mihirji. This was an excellent presentation, excellent brief of the foreign trade policy, different chapters, being very in a crisp manner, presented to give an overview of what was, presented or given in the current policy. I will invite questions from audience, but I have two questions to ask from my end. And one was this, that as a practitioner of the foreign trade related areas, what is the maybe top 2 or 3 major differences you have seen in this policy in comparison to be it the 1520 which got extended till 23 or the previous one? So what do you think, which are the top 2-3 areas which you think are really game-changing ideas? And the second question is that since we have we need to see the diversification happening, and our Commerce Minister, Honorable Commerce Minister, has spoken about this, that Indian exporter needs to diversify and explore other countries as well, whether it is African continent, or whether it is South America, or sometimes even not fully, if full East Asia has been explored. So are there any specific incentives to sort of push the exporters, Indian exporters, to go to these newer market and explore, then be only with the traditional US European market which has been there? So these would be two broader question I would want to have some feedback from.
Okay, let me start with the second one first, so that it's easy for people to recollect. Mr. Mukti, the idea is correct that we need to focus on specific markets, but the idea also of the government is to become self-sustainable and to do away with the idea of incentives and benefits on a small basis. We have gone out of the days due to various reasons, including the WTO compilation, challenges, that where we have any market-specific incentives. The market thing is been now taken care, and the idea and the focus is very simple. Let's not talk about incentives. Let's talk about broader aspects through the foreign trade agreements, FTAs. So those are being taken. We've had typically we talk about UAE and Australia. A silent background, if you people don't remember, is Mauritius, which just happened before UAE actually. We now are very seriously talking on Canada, UK, Europe, maybe even a GCC block, and many others. So this is the kind of a larger spectrum where we're not just talking about merely a small percentage of incentives here and there. We're talking about a larger aspect of it. the idea is very clear. You have to become self-sustained, and Indian goods are going to be demanded. Don't just go into the small nitty-gritties. We have done away with. I mean, those were days where specific countries, specific focus market schemes were there. We have gone out of that regime long ago. Going to your first question is, what are the key changers in from the old policies? Certainly, number one is digitization. I compliment Ministry of Commerce and more specifically DGFT per se, is the amount of hard work they have done on that technology side is tremendous. I'll give you a very specific example. Many of you have fantastic websites, corporates, companies, government institutions. We generally don't expect them to have a very fantastic website. In fact, DGFT has this portal which has been now running very successfully, and they have incorporated everything on their single platform. But a very beautiful thing which many of you don't know, it has on day one itself, it had it, and now it's still there, is they have an artificial intelligence based chatbot. Ask Wahi. A Wahi chatbot is available where a layman who doesn't understand anything about exports, who doesn't know what to do, can probably go to the chatbot and ask, and it is an artificial intelligence based thing, and it will answer you, not only saying do this or do that, it will link you to that particular notification or a file and a process. And that's something which is fantastic. We've not seen in decades ago where department goes to explain you that how you're supposed to file an application or this. Now, the moment a new module is released, you will have a YouTube video available, step-by-step tutorial, how you're supposed to do it. Now, how better can they facilitate it? So that's number one in terms of, we have gone into a very simplified digitized process. The idea is very simple. I'll give you another example. The department follows a process of every day there is a online open virtual conference, a video conference available with all the regional offices across India. Any exporter who has a query can go and hop on. In fact, a very recent thing they have said is, you have a personal hearing, you request the time online, you make a request to the specific officer who has called you for personal hearing, and you could do that virtually. So no physical requirement to go to any DGFT office. The data syncs systematically through the system. The idea is auto. Half of your data is pre-filled. I mean, I don't know how many of you recollect in the old times, if you had to make an application to DGFT for any license or any procedure, 5 documents were standard. You had to give an IC copy, you had to give this, you had to give that. Now the point is, you don't have to give it. It is pre-filled for you. You just need to save next. You see, you verify, it goes ahead. So simplification, making it system driven, making simplification. I have seen things which probably would have taken a week or 10 days in a normal scenario, have now taken 10 minutes, 20 minutes a day. That's it. So that's the kind of the ease which is there compared to the previous one. The second, which I think again it's a technology, but it's a more of a policy driven, is.
Yeah, this is what I was just asking, intervening in that simplified process, more tech driven, or it is also reducing the compliances and everything. So it's mix of both, that means.
It's a mix of both. So no, but I'll tell you what. So it's like this. It is technology driven, but Deepakji, what happens is, because it is technology driven, the compliance problem automatically goes away, because now you don't need to prove lot many things by an additional CA certification, additional this, additional that, because it is already there. So the reason why there were more complexity or more compliances was because you had to prove. I'll give you a very classic example. I mean, there were days where, and I'm talking about at least 90s, where you would apply for an IC and you had to put 2 self-addressed envelopes to the department, one for because you would get an IC certificate, and one addressed to the bank, your bank. So the IC copy would go to the bank, and then bank would get it and they would verify it, yes, it is all data. Cut to 2022, cut to 2021, cut to the current period. You don't require any documents, because they say you have a GST number, you have a bank cancelled check, you have a company SIN number. The data is already taken from all these 3 places, synced and they have already done your KYC, why we would do your KYC again? We trust those authorities, we trust the bank, we trust the GST, we would give you the data. You did not need to do anything. You will get an IC instantaneously on the system. Your updates happen immediately. So this is where it is reduced. This is where, of course, technology has played a role, but the idea that I don't want people to do it, I want to rely on system, is also a very big changer which has happened. More and more, understanding that we need to be quick. See, export also requires things to happen very fast. You cannot have your own luxury of time because your buyer is not going to take that. So whether it is the certificate of origins, whether it is the licenses and the permissions, things have become much faster. It is up to you. It is out to you. And in that, obviously, there are chances of nuances of some errors, omissions, corrections. That has also been understood. So I think, A, obviously, it's a technology, it's an understanding policy based. B, it is also, that I would say that liquidity or that ease, that I can flexibility. Today, if there's a need arises, because it is technology driven, obviously at the back end, but because need arises, I can stop certain licenses. I can stop giving you this permission. I can stop doing that. And if the need arises, I can start immediately in the same day. I mean, it could be a switch on and switch off for just 24 hours or for 24 months. It's up to the requirement. So that flexibility which is available now compared to in the previous scenarios. And lastly, I think the department is more and more approachable now. I mean, they understand that and I think that the term or the idea which they have come out with Niryat Bandhu, friends of exporters, is exactly apt. They want to become friends. They are governing authority. They are a regulatory body. But the idea is they want to encompass is, don't treat us as a regulatory body only. We are your friends. We are your supporters. And jointly, let's grow the Indian exports. I think that's the key element which is there.
Great. I think thank you very much for summarizing, those aspects of going digital, simplification of process, and then sheer approachability from the department point of view and ease of connectivity actually with them, which we have been seeing over the years. And I mean, we must acknowledge one fact that the current government, has been driving a lot of things from a technology point of view in a very, very swift and fast manner. And I also do, get this feedback from exporters on not just on this process part, but entire value chain, that how they have got benefited through this all faceless and no physical and all digital kind of initiatives of government, and where things took months, now it takes weeks, and wherever it took week, it takes days now. So that kind of efficiency has been brought in. We still really talk about many things not still being competitive vis-a-vis say what China is doing from an export term or many other things, but I think we'll catch up, and but the speed is phenomenal these days. And I think this will take maybe some more time, but I think we'll catch up somewhere. So that's the good news about whatever happening in the exim part as well. So I think with that, I would really like to appreciate your spending time with us, sharing the details. So again, thank you very much for being part of our session. We were expecting actually DC to log in, but he hasn't logged in because he had a meeting at Mantralaya. So that's why they told me that he will come at 4 and then talk about what Maharashtra is doing from an export facilitation point of view. But maybe we'll keep it for some other day because we're just approaching our closure timeline. So I would probably again put a formal vote of thanks to all our speakers over the 4 days who have come and shared their views with us. All our partners, FICCI CMSME, FICCI Flow Mumbai, who actually helped us reaching out to various, what I say, industry sectors and women entrepreneurs, smaller entrepreneurs, exporters, everyone to be part of this through our various platforms. And our partners, ECGC, InvoiceSmart, for supporting us in this particular endeavor. And we hope, that these presentations and the material which is being presented or information which is being presented would be helpful to participant and as well as whoever will refer them on our FICCI YouTube channel later on, so that they can take a qualitative decision based on this information. And so with that note, I would like to close this session, and we hope now to make this maybe um, a practice of doing every 6 months, and maybe now next time in a physical mode, because in Mumbai, being a rainy season, it was slightly challenging to do the MSME week in a physical mode, because this is International MSME Week is a day also during this time, but we intend to make it physical also, and then see much more networking also coming into play apart from the knowledge sharing. So I would like to thank again everyone, all the participants who participated, all the speakers for being part of MSME Week, and have a good weekend ahead. Thank you very much.